Welcome to the Get Rich Slowly podcast, where we explore the timeless principles of building lasting wealth through patience, discipline, and the power of compounding. Today, we're diving into a powerful framework called the Get Rich Slowly Compounding Pyramid, a structured, disciplined approach to investing that can set you on a lifelong path to financial freedom. The problem: most people chase quick wins, jumping from one hot stock or crypto craze to the next, only to lose money and momentum. The solution: build a portfolio that balances stability and growth, reinvesting gains to create a virtuous cycle of compounding wealth. This pyramid isn't about getting rich quick. It's about getting rich slowly, leveraging time and consistency to turn small, smart choices into significant wealth. Let's break down how this pyramid works and why it's the cornerstone of a lifelong investing journey. Picture a pyramid, sturdy at the base, narrowing as it rises. At the bottom, forming the foundation, is the largest portion of your portfolio. 60 to 75% invested in the SPY, the S&P 500 ETF. Why the SPY? It's a powerhouse of stability and growth, tracking the 500 largest companies in the US across every major industry. Think of it as the bedrock of your wealth-building journey. The S&P 500 has delivered an average annual return of about 10% over the past century through wars, recessions, and market crashes. That's not a guarantee of future performance, but it's a proven track record of resilience. By allocating the majority of your portfolio here, you're betting on the long-term growth of the US economy, which has consistently trended upward over decades. This isn't flashy, it's reliable. For example, if you invest $10,000 in the SPY and it grows at 8% annually, it could be worth over $100,000 in 30 years. That's the power of compounding at work, and it's why the SPY forms the base of our pyramid. The key is to start early, invest consistently, and let time do the heavy lifting. Now let's move up to the next layer of the pyramid: 10 to 15% of your portfolio in specialized ETFs. These are exchange-traded funds that give you exposure to specific sectors, themes, or asset classes like technology, healthcare, real estate, or even international markets. This layer adds diversification beyond the broad market exposure of the SPY. For instance, a tech-focused ETF might capture growth from emerging trends like artificial intelligence, while a real estate ETF could provide income through dividends. The beauty of ETFs is their low cost and built-in diversification. You're not betting on a single company, but on a basket of them. This layer allows you to tilt your portfolio toward areas you believe in without taking on the risk of individual stocks. For example, if you allocate $5,000 to a tech ETF and it grows at 12% annually, it could nearly double in a decade. The goal here isn't to chase trends, but to thoughtfully diversify, adding a bit of extra growth potential while keeping risk in check. The next layer, also 10 to 15% of your portfolio, is individual stocks. This is where you can take a more active role, picking companies you understand and believe in. Stocks offer higher potential returns but come with higher risk. Individual companies can soar or crash in ways the broader market doesn't. The key is to be selective and strategic. Focus on quality companies with strong fundamentals. Think consistent earnings, low debt, and a competitive edge. For example, investing in a company like Apple or Microsoft might complement your SPY holdings, as these giants drive much of the index's growth, but don't overdo it. Limit this layer to 10 to 15% to avoid betting too much on a single company's success. If you pick well, this portion can juice your returns. Say you invest $5,000 in a stock that grows 15% annually. In 20 years, it could be worth over $80,000. But if it flops, your broader portfolio, anchored by the SPY, stays intact. This layer is about calculated risks, not gambling. At the top of the pyramid, also 10 to 15%, is the speculative layer: crypto, alternative assets, or other high-risk, high-reward investments. This is the smallest and riskiest part of your portfolio, where you can take a chance on emerging trends like blockchain and decentralized finance. This layer is about embracing calculated speculation while keeping it a small part of your overall strategy. Here's where the Get Rich Slowly Compounding Pyramid gets exciting: the reinvestment strategy. When your higher risk assets, stocks or speculative investments like crypto, generate significant gains, you don't splurge on a new car or a bigger house. Instead, You cycle those gains back into the SPY, the stable base of your pyramid. This creates a virtuous cycle, or what we call a compounding flywheel. Let's say your $5,000 crypto investment grows to $20,000. Instead of cashing out to buy luxury goods, you move that $20,000 into the SPY, where it can grow more reliably at 8 to 10% annually. Over the next 20 years, that $20,000 could become over $90,000. By reinvesting gains from riskier assets into your stable base, you amplify the power of compounding while reducing overall risk. It's like pruning a tree, cutting back the wild growth to strengthen the core. This reinvestment strategy is what separates the get-rich-slowly approach from the get-rich-quick mindset. Most people chase the next big thing, hoping for a windfall they can spend. But the wise investor knows that wealth isn't built by cashing out. It's built by staying in the game, letting gains compound over decades. Think of it like a snowball rolling downhill. The longer it rolls, the bigger it gets, but only if you keep it moving. Every time you reinvest, you're adding more mass to that snowball, accelerating its growth. For instance, if you start with $50,000 in the pyramid, say 70% in SPY, 10% in ETFs, 10% in stocks, and 10% in crypto, and you consistently reinvest gains into the SPY, your portfolio could grow to over $500,000 in 30 years at an average 8% return. That's not a fantasy, it's math. The beauty of the compounding pyramid is its balance. Now, the SPY gives you stability and steady growth. ETFs add targeted diversification. Stocks offer a chance for higher returns. And speculative assets like crypto provide a shot at outsized gains. But the real magic happens when you reinvest those gains back into the base. This isn't about timing the market or picking the perfect stock. It's about creating a system that works over time. Most people fail because they overcomplicate investing or chase quick riches. They buy high, sell low, or blow their gains on lifestyle upgrades. The pyramid keeps you grounded with 60 to 75% in the SPY acting as your anchor, ensuring that even if your speculative bets don't perform very well, your portfolio remains resilient. The compounding pyramid also protects you from the emotional roller coaster of investing. Markets will crash, crypto can tank, and stocks will have bad years. But with 60 to 75% in the SPY, you're insulated from the worst of it. When your speculative bets pay off, you don't get greedy. You reinvest into the stable base. When markets dip, you don't panic. You keep investing, knowing that time smooths out the bumps. This emotional discipline is what separates the wealthy from those who stay broke. Most people sabotage themselves by reacting to short-term noise. The pyramid gives you a framework to stay calm and keep compounding. One practical tip for building your pyramid: start with what you can afford. If you're new to investing, allocate 70% to the SPY, 15% to a sector ETF like technology or healthcare, 10% to a few solid stocks, and 5% to something speculative like crypto. Use low-cost platforms to minimize fees, as even 1% in fees can shave thousands off your wealth over decades. As your portfolio grows, periodically rebalance to maintain the pyramid's structure, sell some of your winners in the stock or speculative layers, and move those gains to the SPY. This keeps your risk in check while fueling the compounding flywheel. The GRS slowly compounding pyramid isn't just a strategy, it's a mindset. It's about rejecting the myth of overnight riches and embracing the reality that wealth is built slowly through consistent, intentional choices. There's no shortcut, no secret hack. The wealthy don't get there by gambling on the next big thing. They get there by building a system that compounds over time. This pyramid gives you that system: a stable base in the SPY, diversified growth through ETFs and stocks, a sprinkle of speculation for potential upside, and a reinvestment strategy that keeps the flywheel spinning. As we wrap up, let me leave you with this: every dollar you invest today is a seed for your future wealth. The compounding pyramid shows you how to plant those seeds wisely and nurture them over decades. It's not about how much you start with. It's about starting, staying disciplined, and always reinvesting your gains. Wealth isn't a sprint, it's a marathon, and the pyramid is your roadmap. Keep compounding, stay patient, and you'll build a financial future most people only dream of. Thanks for tuning in to Get Rich Slowly. If this episode inspired you, share it with someone who's ready to start their own compounding journey. Let's keep spreading the word that getting rich slowly is the only way that works. See you next episode.